And we're going to swap. Okay, awesome. So thank you all for coming. This is Breaking Into Small Multifamily Real Estate. I really appreciate you guys carving out about 30 minutes of your night to join us. So what we're going to be referring to with small multifamily real estate, it's any residential property that has 2 to 4 units. So we call these flats in Chicago. So a 2 flat, 3 flat, or 4 flat. Now, what we're not going to be talking about is anything that's 5 units and above. That's going to be considered commercial. It's a whole nother ball game. Tonight is just 2 to 4 units. So who am I? My name is Jason Wagner. I'm the managing broker and owner of Greystone Realty. And Greystone Realty is a startup brokerage here in Chicago. The thing that we pride ourselves on is that each and every one of our agents is an investor first and a real estate agent second. So we all own investment properties, and we love to pass along our education and our successes and failures of our own projects and pass that on to our clients and the people that we work with. We just feel that anybody getting into real estate investing for the first time, or if you're adding to your portfolio, it's so beneficial to have somebody, especially your agent, that has that hands-on experience and they can kind of guide you and advise you. So I'm also really thrilled to have Joel Schaub on the call with us. So Joel is the Vice President of Mortgage Lending at Guarantee Rate. And Joel is, honestly, he's a very awesome guy. And he always impresses me because I think he's one of the best lenders in the whole country. And his numbers actually show it. So I'm gonna pass it over to Joel for a quick intro. Joel, hey, how you doing?
I'm doing great, but it's not about me. You guys should get credit for taking time out of your night. You're awesome. You're being too modest because you're really taking time to give back, teach, and educate. And that's really what it's all about, especially when it comes to the financing side of this. We're going to get into some really great things. And at the end of the session, everyone on the call is going to understand financing, the numbers, and really walk away with something great tonight. So I'm excited to be here.
Awesome. Thanks, Joel. All right, so guys, so I wanted to show you my current portfolio. So between me and my wife, we have 8 units, and it's spanned across 3 different properties. Tonight's conversation is all going to be on this one on your left. This is the 4 flat that we bought in Portage Park, and this was a house hack. So what's a house hack? It basically just means we lived in that top floor unit, and then we rented out the other 3. So we're going to walk through the numbers of what it looked like when we first bought it, and then 2 years later, after we've already moved out, how that property is performing for us today. So before we get into that, I do have kind of my top 5 reasons on why you should be considering multifamily real estate. So the first one is cash flow. It's the opportunity to significantly reduce your monthly living expenses or live for free. The second one is principal pay down, and this is grow your equity ownership by having your tenants pay your mortgage. You can absolutely say that when you're a landlord, that your tenants are helping you pay your mortgage. The third one is appreciation. So the gain in market value over time or through renovation. So 2 to 4 units, just like single family homes, will appreciate. So number 4 is tax benefits. This one's often overlooked by a lot of newbie investors. But you can reduce your taxable income through depreciation. Okay, and the 5th one is advantageous financing. So low down payment options and low interest rates for owner-occupied buyers. A lot of people think that you need a lot of money to get started in real estate investing, but it's just not the case as long as you are willing to commit to living in the property for at least 1 year. So let's dive into this first one. Let's cash flow. Let's say that you are a buyer right now and you want to buy something this year. You've heard about the market, you've considered a single family home, a condo maybe, or you've kind of heard about these multi-units that are scattered around Chicago, right? Let's take a look at each one of these. So looking at a single family home and a condo, we're both looking at these properties marked at $350,000. So you want to put down the minimum that you can. So 3.5%, which would be an FHA loan. It's about $12,000. As we kind of scroll down, we look at what our mortgage is, our taxes, our home insurance, and then for the condo or townhome, there might be an HOA fee that goes with that, right? So you're kind of signing up for this $350,000 purchase, about $2,300 or $2,500 in total, right? Now let's kind of flip this around to the owner-occupied 4-flat. Now, chances are this multi-unit is going to be more expensive than a single-family home. So we've doubled the price. We're up at $700,000 now. And a lot of people would be like, $700,000, get out of here. I can't afford that. But let's actually break down the numbers a little bit, right? So our down payment will have to increase, but it's still 3.5%. Okay. But then look at this rental income line, this 4125. You've got 3 other units that are paying you rent every single month in this 4-flat, right? You're living in one, and your tenants are paying you. So how does that offset your mortgage, your taxes, your home insurance? And in this quick high-level example, I mean, you're signing up for paying under $500 a month, and you're living in a $700,000 property, right? When you compare these bottom lines here, this is what drew me to multifamily real estate to start with, right? So the opportunity to significantly reduce your monthly living expenses, right? So the second one is principal pay down. And I'm going to pass this one on to Joel. Joel's going to talk about the principal pay down effect.
Jason, I'm really glad that you talked about that higher number, right? Because even when I look at it, I think $700,000, how that could I do that, right? But the magic is in putting down 3.5% and getting really good financing as long as we occupy a property. So if we looked at that slide before and we noticed 12 to 13 grand for the smaller numbers, 24,000 is needed for a much bigger purchase. But just look what happens after 5 years. You already have taken that $24,000 or $25,000. And because somebody else is paying the mortgage, you have over $100,000 of equity. It doesn't happen that way when you buy a smaller $200,000 or $300,000 home, a $200,000, $300,000 condo, but it's the power of having somebody else collect the rents, pay the mortgage for you. You'll have a lot of additional equity if you take advantage of these situations.
Yeah, exactly. Awesome. Thanks, Joel. The third one is appreciation. So this is one of my favorite slides. And here's what I've plotted here, guys. This is condos, 2 to 4 units in single family homes in Chicago. So median sale prices. If you were to look back at December of 2016, the median sale price of a 2 to 4 unit then was $217,000. Let's fast forward 5 years. December of this past year, the median sale price of that same unit is now $382,000. On the right-hand side, we've got a 76% growth rate. This is significantly outperforming condos and single-family homes, right? So when you combine this appreciation that you're seeing in multifamily, and then you also have reduced living expenses, right? And your tenants are helping you pay your mortgage. All of these things together should start to get you excited about the possibilities that multifamily real estate can do for you in really only a short period of time, right? So let's keep going. So the fourth one here is tax benefits. Reduce your taxable income through depreciation. So what is depreciation, right? So it's an accounting method that allows real estate investors to spread out the cost of an asset over an expected useful life. So the IRS is going to say that you can depreciate your property by 27.5 years, right? Now, there is one caveat here, is that you can't depreciate the whole property value. It's just the building value, and you cannot depreciate the land value. So the reason they say that is the building's going to go through wear and tear and the land won't, right? So you're going to work with your accountant to come up with this annual depreciation number. But to keep it simple, on the right-hand side here, I've got an example where we buy a $700,000 4-unit, right? And as we work with our accountant, as we come to this annual number, we see that we can write off $19,000 for annual depreciation. Okay, so what does this actually mean, right? So let's just say your property generates $20,000 in annual cash flow. And when I say cash flow, I mean profit, like money that is after your expenses. So you have enough rent, it covers your expenses, and this is your flat out profit. You don't have to pay taxes on that full $20,000. You actually get to write off 19,000 of it. And in this situation, you're only paying taxes on 910 bucks. That's huge. And it's a lot of newer investors just kind of overlook this huge component of the tax benefit that's out there. So number 5, this is another great slide. There's advantageous financing. I'm going to pass this one on to Joel. This is the how-to to get started in multifamily world.
It's all about cash on cash returns, right, you guys? So figuring out what the loan limits are. And as it starts to rain where I'm at, I'll talk up so that everybody can hear me. The idea here is 3.5% down. The numbers on the left are vital to know how much you can borrow. So on a 2-unit building, $538,000, all the way up to $809,000 for a 4-unit building. And Jason, we talked about this before, right? You can buy any size property, but we need to be below those numbers for the loan, right?
Mm-hmm.
Okay. Whereas unadvantageous financing, or just what everybody else goes out and get if they've already owned a property or have FHA, requires a much bigger down payment. And not to say that it's bad, but look at the numbers on the right-hand side before I go to convention. I definitely like the idea of putting down 24 or 25 grand versus putting down over $100,000 into a property, okay? If we don't utilize FHA financing, the only name in the game is conventional loans. And for a 2-unit building, it requires 15% down. And for all 2 to 4 unit buildings, it requires 20% down. So going back to FHA, 3.5% all the way up to $809,000. And that doesn't have an income limit. So you could be a teacher or whatever your job is, making $50,000, $60,000, $70,000 a year. You get to use the rental incomes to get you up to numbers that you would never qualify for if we're just buying a house, a condo, or a townhome. So that definitely gets people excited when they understand the buying power that financing and mortgages can help you with. And that's for 5. And back to Jason for number 6.
Awesome. Cool. So we are going to analyze that deal. So that 4-unit that Rachel and I bought, this is the house hack, right? So we lived in that top floor unit and then we rented out the other 3. So let's go through the numbers on this one, right? So we bought it for $725,000. We utilized FHA financing, and this was in December of 2019. So relatively recent, right? Again, 4 units. So the unit mix at the time of acquisition was we had 2 units that were 2-bed, 1 bath, and 2 units that were 3-bed, 1 bath. And overall, the condition of this property was about 75% renovated. So there was really only 1 unit that was left over that just wasn't updated. And what we really liked about this deal was that the one Rachel and I were going to be moving into was in great shape. We felt comfortable with it. And there was the opportunity to add a little bit more equity into the deal by renovating that 1 last unit. So on the right-hand side, you'll see this was all we needed in order to close on this property. So just under $34,000. Now let's take a look at the actual income and expenses on this deal. We're calculating here what cash flow is. So that is your total income minus your total expenses. It's the same as your profit and loss, right? So let's take a look at the income first. So unit G was paying us $1,195 when we first got this. Unit 1 was at $1,580. Unit 2 was only at $1,200. And one thing I want to point out about Unit 2 was that this was the one that was not renovated, okay? Unit 3, this is where we're moving into. We don't have a rent on that. Rachel and I are at a 0. We didn't have any parking rent when we first got it, but we did have coin laundry in the basement that was generating, believe it or not, $110 a month from coin laundry, okay? In total, we were just under $4,100 a month in total income. Let's jump over to the expense side. What does it cost to actually operate this building? Now, this is a typical expense sheet that you will see for a 2 to 4 unit property. I'm not going to go through each one of these, but I'm going to highlight some of the ones that a lot of newer investors are going to miss. And the first one is vacancy. And what is vacancy? Vacancy is kind of this phantom expense that doesn't show up until you don't have somebody paying you rent. So let's say you have one of your tenants and they move out, and it takes you a full month to get somebody else in there, right? That 1 month gap of no rent is going to be your vacancy expense. And so this is often calculated as a percentage of the total income. So I took that total monthly income of $40.85 times 5% equals that $204 per month. So that 5% is a pretty standard percentage that you'll find throughout Chicago. Maybe you could bump it up to 6 or 7, but I felt comfortable at the time using 5% on my deal. Let's jump down to the snow lawn property management. Okay, we got zeros in here because, again, we owner occupied this property and I felt I could shovel the snow, mow the lawn, and manage my tenants no problem. How about repairs and maintenance? Okay, so things are going to break in your property. You're going to have to unclog some drains and fix some things, right? So you should budget a repairs and maintenance item. I ended up using the same methodology, a percentage of the total income at 5%. Okay, so it may vary based off of the age of the property and if things are renovated or not. If you remember, this one is 75% renovated. I used a lower repair and maintenance budget. But if you've got another property that is, it's not renovated at all and everything is older, maybe I would bump that up to 8, 9, or 10% on your repairs and maintenance. Okay. And then the last one here is CapEx, also called capital expenditures. This is for your big ticket items, like if your roof needs to be replaced, or if a furnace or AC condenser breaks unexpectedly, right? So this is another line item for those big ticket items. And again, on this one, I used a percentage of the total income at 5%, just because majority of the building, everything was relatively newer. You could also have a completely different schedule for your CapEx expenditure. It will vary by property. So it's good to have some type of back and forth and some thought process that goes into your CapEx budget. So on this one, again, I felt comfortable at 5%. In total, we were just under $5,200 in our total expenses. So let's calculate what our cash flow is and what mine and Rachel's obligation is going to be. So the $40.85 minus the $51.86 means that we're paying $1,100 a month to live in this property. Okay, now compare that to our current situation at the time where we were renting a 2-bed, 1-bath for $1,700 a month. So we just signed up for buying the $725,000 property, which is now a 3-bed, 1-bath that we're living in, and we're only paying $1,100 a month. That made a lot of sense to us, and we closed on this deal, right? So what about 2 years later? Let's just see how the property has improved and what has happened. So let's look at the income first. So Rachel and I have moved out. We now live in a single family home. So you'll notice that unit 3 went from a 0 to $1,850. That's the new market rent for our unit. Unit 2, take a look at this one, was at $1,200 when we bought it, but that tenant vacated and we were able to renovate that unit. We converted it from a 2-bed, 1-bath into a 3-bed, 1-bath, which brought that rent up to $1,850 as well. Unit G and Unit 1, we've been able to increase those rents to more of a market rate, and we found additional income from the parking rent. So we had a 2-car garage and we leased out each space for $100 a piece. And that laundry income is still coming in, $110 a month. So in total, if you look, we've increased our rent or our income on this property by almost $3,000. And so we've got a total of $7,000, right? How about the expenses? What's happened here? So let's look at that vacancy number first, right? So because our income has increased, we're going to take 5% of that new income number, and we're expecting a vacancy expense to be about $353 a month now. Let's drop down to repairs and maintenance. So here's what I actually have an actual number in here. The $264 a month, this is what I paid last year for repairs and maintenance. So it was a little bit more than what I was anticipating. Just a few more drains got clogged that I had to make a few calls on. But here I did have a win on my CapEx. So didn't spend as much, only $134 versus the $204 I had budgeted. There is one big item that did help us. We were able to refinance our mortgage. So after we completed the renovation on Unit 2, interest rates dropped. It made sense for us to refinance, and we saved over $200 a month on our mortgage. At the end of the day, look at our total expenses, relatively unchanged. So let's calculate what the cash flow is now. So 7060 minus the 5188 equals every single month we are earning 1872 from this property. So that is cash, guys. That is money in our pocket. We've already paid all of our obligations. This is free to use. It's kind of like your side hustle without any more hustle anymore, right? Because we put in all the hustle in the front end, and now this property is stabilized, and we can expect to be earning every single month almost $1,900 if we continue to perform at the same rate that we're performing right now. So what does that mean on an annual number? We'll just take that 1872 times 12, and every single year we're looking at over $22,000 just from owning this one property. Now, remember how we can tie this all together, right? Remember that our tenants are helping us pay down our mortgage. We have that principal pay down effect. We also are riding a huge appreciation wave where historically 2 to 4 units have been outperforming condos and single family homes in Chicago. And then we're not going to be paying taxes on that whole $22,000. We've got depreciation, right? We're going to be paying taxes on a fraction of that. And then don't forget, we did all this with an FHA mortgage. It only cost us 3.5% to get into this property and start generating this type of cash flow for us. So let's do one more calculation real quick. Let's figure out if that $22,000 is actually a good number. We're going to do a return analysis here. And if you remember, we did refinance the mortgage, so I do have a new appraised value on this property. It came in at $800,000. We bought it for $725,000, meaning we already have unlocked $75,000 in equity, and that happened to cover our renovation costs of that unit 2 that we did. So our total investment now in on this property is $106,000, and now we want to figure out how much is that $106,000 that we have sunk into this 4 units? How much is that actually being earned on an annual basis now? So $22,000 is our annual cash flow divided by our $106,000 equals 21% cash on cash return. So what does that mean? Basically, that means in 5 years, guys, we're going to have all of our investment back, plus we'll have appreciation, plus our principal will be paid down. And who knows what the value of this property is going to be in 5 years, right? So where do you guys take it from here? I would say let's educate yourself as much as you can, especially if you're a newer investor. This is a great read. This is The Multifamily Millionaire by Brandon Turner. This is published by Bigger Pockets. Bigger Pockets is definitely the best source for all of your real estate investing education. So go check this book out, go check out Bigger Pockets, and invest the time to invest in your own education. And then apply those principles that you've learned from this webinar and from those books, and apply them here in your local market, because you absolutely can. So if you haven't already signed up, but I do a monthly report. It's called the Wagner Report, and I look at the Chicago real estate market in every single neighborhood. I look at condos, 2 to 4 units, and single family homes, and I send that out to all of my subscribers. That way people have a pulse on the market, and you can see where the best neighborhoods are currently. And so finally, we're going to go to any questions that we have, but I just want to say thank you again for coming and carving out the time. I hope that this was beneficial. You were able to see the before and after. And if you want to take this to another level and you want to have a conversation and see how we can get you into a property here in Chicago, please reach out to us. Below is our contact information. Joel can get you pre-approved, and we can talk through what your game plan looks like. So why don't we turn it over to any questions that we have, Marie, or let's see what came through.
There are so many in here. Thank you guys, to Jeannie, to Ashley, to John, to Ryan, JC. It's amazing. So it makes a lot of sense to chime in early. Marie, I don't think you're off mute yet. So I'm going to take the first one. And there you are.
Hi.
Perfect.
Okay, so the first question